Hi, guys, and welcome back to another show. My name is Tyler, and I'm with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to answer some questions about forward volatility, our SMV process, and certain symbols in the backtester. Matt, do you want to get us started and share your screen?
Sure. Let's start with the hard one, forward volatility. So forward volatilities are a way to measure volatility in between what's a normal kind of constant maturity. So like, let's just say we have 30 and 60 day Apple is 27 on the 30 and 25 on the 60. So what do we know about between the 30 and the 60? Is it higher than 27 or lower than 27.8? So it would have to be lower because for the 60-day average, so to speak, it's 25. So do you get that so far, Tyler?
Yeah, it's kind of just checking the in between. Are we going to do some interpolation here?
Well, we're not going to do the interpolation because it's not exact. But so here's that. So again, I'll bring these over. So what we're saying is like the forward volatility or the volatility between these two. So it's for 30 days, it's 27. So you have 0.278 here. And then what do you have in between here, right? So then you have, in order to make kind of the average 25, it's 0.227. I guess we could do this weighted average, right? So we could do equals this times 30 and same thing for this. Add those two together and divide by 60 and see what that comes up with just for a reasonableness check, right? And that is 25.25. So very close. Do you see what I did there? So
yeah,
basically what forward volatility does is it looks at, okay, the implied volatility for the first 30 days is going to be 27. We know it's 25 for the 60 day. What is it in between there? So I just said, well, for 30 days times the volatility, it's 8.3. For these days, for 30 days, it's going to be 2.27, and that equals what it actually is. So that checks out, so to speak. So far, so good.
Yeah. So what does this metric mean? Like, what is it used for?
Well, it's good to check out. I mean, if you're going to do a calendar spread, this might be a really good volatility for Apple to buy. Now, what I know in Apple is that the earnings are in between there. Earnings are in a couple of days. That's why we're in kind of a backwardation or negative contango situation right now. So what'll happen after this is done is Apple's skew will come down and there'll be a big move and the skew will come down. So, if you do a calendar, sometimes it's a little risky, but that's the calculation that you could do for that.
Got it. Okay. Is there any, I'm just thinking about the optimizer tool in the new dashboard. Do you use it there at all? Has it been proven to be kind of a predictive indicator?
Yeah, so we use so in the dashboard, I thought it was going to be corrupt. So if you go to my save backtests, if you look in the indicators, so here's like an FB, and we'll talk about what that means. Let's kind of go through. So there are 11 of these that use FB. This is the forward 180 to 90, 180 to 90, 30 to 20. So, a number of these use that.
Okay.
this, but you're getting a little ahead of ourselves right now, Tyler.
Okay, we'll come back to it.
Because the FB is a different one. So just this alone, no, it's not that popular. But what we're going to show is kind of an inventive ORATS proprietary calculation that I've never seen out there, and it is quite important. So that's the first one. So understand that. So that's the forward. But there's another way that some of the traders, when I used to trade on the floor, would look at the forward rates, and they would look at it by calculating it based on the value of the calendar. So you would say, okay, what is the call 30 days out? Okay, it's $2. What is the call 60 days out? Well, it's $3. Well, so that's a $1 calendar, but one's at a 27.8 vol here and one's at a 25 vol. What is the flat vol? Like, what is the flat volatility that's going to make that calculation come out to be $1?
I see. So this is the first step, right? Yeah. Calculating the in-between volatility. And the second step is bringing in real market data to try to calculate like a no arbitrage value or something like that.
Well, it just calculates a theoretical value, theoretical volatility, and it's kind of another gut check on this, right? Because if you're going to buy a calendar for $1 and you set the volatilities equal, what is that volatility?
Mm-hmm.
Does that make sense?
Yeah.
So in this case, the FF, or the flat forward volatility, is here. So 60-30 is this. And so, I mean, what do you notice?
Well, it's lower.
Right. It's much lower. And what we found is that when the market's in kind of turmoil, that these numbers get off. One goes higher, one goes lower, etc. And we've also found that it's an important indicator when these numbers are not matching. And it's one of my favorite ones because it's pretty hidden, and we started looking at it. We go, why is it different at certain times? Like right now we're in backwardation, and it's very different. If you're in kind of contango or a flat skew, it's similar. So it's usually the calculation is pretty similar.
So the calculation kind of correlates to contango a little bit.
A little bit, but contango and negative contango, you should say.
Okay.
That's when the market's in turmoil.
So why would it be going down here? Because the calls they're not lining up with the volatility.
Well, yeah, the $1 calculate, like the difference is not consistent with the other calculation. Meaning there's kind of an implied theoretical volatility here, and there's another one. This is more of a calculated value, interpolated value, and it's subtle, but it's an important difference. Yeah. So one's a theory, like the best calendar trader. There used to be just calendar traders on the floor way back when, if you could believe it, and they would really think about what the volatility is when this 30-60 is worth $1, for example. They would know that that's a cheap or an expensive time to do that trade. And so that's why I started measuring it. And then I started noticing that there was a ratio. So like, what is the ratio between the forward and the flat forward? So then we have that number that we present. So that number,
can I just clarify? So it's a little bit confusing because most people derive the volatilities of this 30 and 60 based off of the option price. So
that's not true. Most people do it this way. When they calculate a forward rate, whenever you look at forward rate on the internet, they're doing it this way. They're saying, it's the easy way. Like we almost came up exactly with it, just with a weighted average here, right?
Okay.
So this is the way that most people count, if they even go that far to think about a forward volatility, they would do it kind of mathematically, and this is that mathematical way.
Okay.
What it was rare to see people doing it this way, and they were actually pretty good traders. They were the successful traders. They would say, well, what is the, there's a kind of a moving calculation that you need to do with two separate Black-Scholes formulas calculating at the same time, and that's what we do to calculate this number.
Okay.
And then so then you could see that this is usually 1, right? FB means this divided by that, this by this, right?
Okay.
So, oh, sorry, I lost my. So that by that. So that becomes 0.8, and then we could go to like a we could go to the outlook, for example, or actually we need to go to the trade builder, right, to look at that. So so an Apple, if we want to add this indicator, FB 6030, right? That's what we have. So, here's 1, right? And here is where it is now, like we observed, right? And then, so what we've noticed a lot with this calculation, and I'll turn on my drawing tool now, that that this peak and this valley kind of match this peak and this valley, and this rally matches this rally. So we were like, oh crap, look at this. This thing kind of matches up, right? Like with the stock. I mean, not always, but like there is a fair degree of correlation. And so we found this to be, like you were asking before, a much more valuable calculating indicator than just the FF or the F itself, the flat forward or the forward calculation itself. The ratio is a lot better of an indicator, and that's what tends to come up. Like, so what we're looking at now are all my saved backtests. So these are the best backtests that I've found, right? And what we do is we look if there's a good timing indicator here. This is probably a whole show, but so FB, there's one FB there for the ITB iron condor. There's one F there for the XSP call spread. There's one for a long straddle. So there are ways that it's used throughout our optimization process, and it's probably one of the most popular ones. So that's why one of the things that we want to talk about today was the forward volatilities, and not just a forward volatility, but a flat volatility, and then that comparison. So ORATS gets way into it, and that's what we're kind of known for, is our indicators, our data, and so being able to use that data to identify timing, entry, exit. So that's what it's all about. So that's what I wanted to say on the flat forward or the forward volatilities so far. Tyler, do you have any questions, or are there any questions coming from our live studio audience?
Yeah, no comments from the audience right now.
Okay.
But yeah, it was a good explanation. I think it's one of our more complicated indicators to understand, but also one of the most valuable. And like you said, you've taken what you've learned on the floor and applied it to this. I think that's great.
Yeah. So let's talk about our SMV process next, because that kind of makes all this stuff work, because we're doing pretty fine-tuned calculations when we're doing forward vols. You have to have very good at the money volatility. So let's talk about how we get very good at the money volatilities at ORATS. So you can see that these are each expiration for Apple, and there are purple dots and there are cyan dots. The cyan are calls, C for cyan, C for calls, P for purple, P for puts. So put volatility and call volatility, and they often overlap. We have a process in the SMV to make them overlap, and because they should overlap. You should have the same implied volatility for the calls and for the puts, and there should just be one delta and one Greek because there's the equal amount of premium for calls and puts. If you have different volatilities or different Greeks, often you have an incorrect either dividend assumption or implied volatility assumption. So you clear on that, Tyler?
Yep. Yeah. It's if you guys want to follow along, I'd recommend going to our university page and looking at the first few chapters. Kind of goes over our methodologies in written form.
Yeah, good point. So this is such a great. It's almost like a book, but written like a university, written like courses that you could take, very clearly written with some videos interspersed. You could ask questions, and so it's a very good place to do this. You could ask Otto as well, and Otto will take you through. Good point, Tyler.
Mm-hmm.
So the SMV process, so it lines up the calls and puts, which is very important to do, and then it draws this kind of orange skew through it. And this looks easy, is very difficult to do all this. And it's kind of, we used gaming technology in order to kind of figure this out. And so we draw the skew through it. And what that does is, if you get a really wide market, or a crazy market where there's a call way off from the put, like this one, where the volatility is 37 for a put, 34 for a call. In that case, we'd use closer to the put because the calls are much wide. I mean, the calls are $34 and the puts are much more liquid and much more fairly valued. This is very wide market. So we look at that. So we have the whole formula for doing that. And so we draw the line closer to the put in that case than the call. And so we draw this. What's that?
I didn't say anything.
Oh, I'm sorry. I thought I heard something. I apologize. So then what we get is these theoretical values. So in this case, it's worth 50 cents, we think. And we're between the bid and ask like 95% of the time. So it's a very good calculation that we do. And it's extremely important in order to get good Greeks. So we get, so a good calculation, if your volatilities are off or you're using wide markets. So a lot of these brokers and market data providers are pretty lazy about this. Lazy meaning they don't go as much in depthness as we do. Like, it's very difficult to do this, but your Greeks are going to be way off. And if your Greeks are off, then your hedging is going to be off, and your, what you think you're leaning long and you might be short. We also have a concept called RIP value. Maybe we could talk about that if we have time after our next topic. But this SMV value is important for getting Greeks correct, getting the theoretical values correctly. So if you're going to be trading, you're going to be saying, okay, well, the midpoint is 630. We have it worth 632, 633. As you can see, that's changing as the market changes and the stocks change. And so this is an important number to look at when you're trading, because you don't want to pay over this kind of theoretical value. It's uncanny that it seems like the market makers almost have that. Like, if it looks too good to be true, if there's too much smooth market theoretical edge, you're probably not going to get filled. You can see that circle. So, like, for example, on this one, like this call, like we want to, that call, the SMV, you can see how far off that kind of SMV is for that call. That's what we're seeing over there. So that's another really important thing for that the SMV does, Tyler.
Mm-hmm.
And then thirdly, this is how we calculate that at the money. So we draw the skew, and at the 50 delta is where we draw our at the money volatility, and that is a very accurate volatility, and that allows us to do that forward volatility calculation. Does that all make sense?
Gotcha. Yeah. So it kind of starts with just the getting the theoretical values right in between the bid and ask, and then it kind of goes on like calculating really accurate Greeks and IVs, and then those Greeks and IVs, they contribute to really strong proprietary indicators, and those indicators can contribute to signals, basically, right? So it kind of there's just kind of this full process that ORATS has that allows you to create good signals for trading.
Absolutely. So so yeah, I think the next thing that we want to we're talking about listener questions. So people have asked us about the SMV, and then they asked us about the forward vols, but they also asked us, do we do IBIT, IBIT? So yes, we offer data on IBIT. It hasn't been around that long, but we still are able, like, we just need a few days in order to start calculating, our and graphing our historical volatility versus our implied, for example, and to get enough data into our system in order to not only graph this stuff, but we could back test IBIT now. This is our legacy back tester, and IBIT is in our it's in our list already, and it doesn't have that many days. So so that's what we want to talk about. Another thing we want to talk about is what's called a RIP value. And a RIP value is you reminded me of my days on the floor, Tyler. Excuse me. That I was always confused. Like I'm saying, oh, I'm really long. I have these out of the money calls, and they go, I hope you're not selling stock against it. Like the traders are like, because it, like, as the stock goes up, to those calls that you're long, you're not really long it. And if it expires and you're short stock, but you're long those calls, it's good. You're going to lose on both sides. So, and then, so I always wondered, like, how did these really experienced traders that were making a lot of money down there, how did they handle their way out of the money calls and way out of the money puts? And they handle them differently if they were long or if they were short. So that's kind of the subject of the RIP value right now. So the reason I call it the RIP value is they would essentially rip, like, they'd buy 100 of these cheap calls, and then they'd rip up their ticket that they were going to give to their clerk to put it into their positions. And so they wouldn't have their clerk put it into their positions. This is a long time ago when there was paper trading, or not paper trading, a long time ago when they had paper tickets down there. It wasn't electronic yet. And so the clerk wouldn't put it into their position, and they wouldn't look like it was, if they bought calls, it wouldn't look like they were very long, because they bought kind of what they would call lottery tickets. They said, if it hits, it hits. If it doesn't, I'm not going to put any stock against it. Does that make sense so far, Tyler? It's a little bit complicated of a subject.
Yeah, I like the name. I think it's great.
Yeah. So RIP value and so what it's really good for is, like, it's the definition of a RIP value is the price of an option where you should start to take out deltas, and half of that price you should have all the deltas out. So it's kind of linear. Like, so if the RIP value for a stock, and it's all different, I'll tell you how to calculate it. So at $1, so if you have an option that's worth $1, you give it full deltas. But if it goes between $1 and 50 cents, you should have taken, if it's less than 50 cents, you should have no deltas against it. And that's kind of what the RIP value means. And you add up your deltas, you can see, do I need to buy stock, or do I want the stock to go up or down? That's what the That's what it kind of helps with, is managing your position. Market makers would sell the underlying against their delta positions of their options, but with those cheap ones, you don't want to be hedging those with stock. And then the rule for the short is half of it, half of that. So if it's $1, it's 100%. If it's a 50-cent option, whereas you would have no deltas against it if you were long. If you're short, you should have half the deltas. So if it says you're long 100, you should trade it as 50 deltas. So that's how that, all rule of thumb, but all came from interviewing all these people on the floor, and the kind of legends down there. You've probably seen some of them are still on YouTube. So that's how we came up with the RIP value. And the RIP value, the way that we calculate it, it's kind of a funny story. So I would talk to all these people that essentially kind of theoretically did a RIP value. And I would say, well, what is the value for this stock? It's $1. What is the value for this stock? Well, it's a much higher stock, so it's $5. What is the value for this really low stock? Well, it's 50 cents. And so then I had this huge list of stocks and this huge list of values, and I go, what? How could I make this regression work? And so what I did is I go, well, I finally came up with it. It took me a few months. And I go, oh, that's about the value of a 45-day 25 delta put. Does that make sense? So it's like, so that value. So you go to like and I was just showing one of our interns how we calculate that, but it's, so here's a $67 stock. And so we'd go out to the something near the 45 days. So this is closer, 6 days away. So we go to set 5, and you'd go to the 25 delta put. So here's the delta. So here's the 25 delta. So for this would be about $1.45. That would be the RIP value for IBIT. And it depends on IBIT's volatility. If it's really high volatility, it'd be a higher RIP value.
Yeah.
So, and you have to solve for that. Of course, we solve for that and do everything. So that's the RIP value. And we talked about the SMV and how it's important in getting the deltas right, but it's also important to know what to hedge deltas with if you get to that point in your trading career. But what I use deltas for is just, like I have a portfolio. I go, I'm really long and I don't want to be long. Then I'll buy some short deltas in some type of a strategy. How long do I want to be, or how short do I want to be right now? So that's about it for our subjects and our questions. We appreciate you guys putting in questions. Again, you could like or comment, and we get to most of these questions. So it's always good. It helps us out if you comment or like our YouTubes here.
All right. Yeah, thanks, Matt. That was a great description on the RIP value. I kind of always wanted to hear more of the story about that indicator. There's a lot of indicators at ORATS. So.
Oh my God, some people love to hear stories about the floor days. Like we were at the option industry conference, and there was this guy there that just loved it. Like, and I was with Lex, and we were talking about it. I mean, you don't want to wind up at old market makers. They'll talk for days on all this stuff.
That's funny. Yeah, cool. Well, yeah, I'm looking forward to showing more of the optimizer and some of the ways that we use these indicators next week.
Yeah.
The beta will likely be out by then. So if you guys want access, just email us, support@orats.com, and we'll give you access to the beta coming out very shortly here. But yeah, other than that, great show, Matt. Great explanation on some of the more complicated things we do here at ORATS.
Thanks.
If you guys have any questions, like Matt said, just leave a comment in the YouTube. We love answering comments on the live show. It's a great way to get your questions about the dashboard and the data answered. All right. Well, yeah. Thank you, Tradier, for hosting us again, and we'll see you next week.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.